Coming out of the Fed meeting last week, we did see the markets accelerate, but not to the point that we were expecting. Take a look at the Dow Jones or the S&P chart here we see in front of us. And this takes us all the way back to the beginning of summer. And as we enter the first day of fall, we can see what's happened from summer to fall. It's been pretty much a straight up. We had a little bit of a pullback here in August. Looks like a two-day pullback. Didn't last very long. And had a two-day pullback in September. Didn't last very long. So there's been pretty much for the better part of summer, I don't want to say it's been a straight up line up, but it sure looks that way. Now, when I look a little bit deeper, I look at implied volatility. This is really kind of the angst of where the market is perceived to go. And we look at that perception, we can see that, yes, the implied volatility's dropped into summer like they typically do. But what we also see happening here more recently is we're seeing an area where there's a line drawn in the sand up here around, let's call it about 1380 for the at-the-money implied volatility. That's where the option traders expect the next 30 to 60 days to go. Look what's been going on. We've been seeing during August and September, we've seen it kind of punch up from below 12 to above 13.5. We're there again today. Now, is this something that we need to concern ourselves with? That volatility is jumping up? I mean, I don't think this is a big deal. I think if we were spiking up here to the highs for the last 6 months, I would be concerned. I do think this is pretty healthy when you see IV starting to head up. Looking at the bond market after the Fed decision definitely did a top and pullback. And we could see this big red candle right here. This was last Wednesday when the Fed cut rates. We saw that kind of candle up. And then ever since then, coming into today, even lower still. All right, so touching 91 on Wednesday as we're hitting into the high 88s. Not much of a big pullback. I think that we would see some sticking ground here in the 87.90 and 87.15 area. But my expectations is that we're going to see the bond market creating a series of higher highs and higher lows as further rate cuts are likely. Gold has done a really interesting move here in the last week. We saw gold actually moving up ahead of the Fed cut. Then it had about a 2 to 3 day pullback. And it bounced back, and then it's bounced back in a big way, gapping up today. I saw gold itself at $3,750 an ounce. That's what we're seeing with GLD gapping higher, trading in the low 340s as we speak. And again, like the stock market, I expect to see gold continue to move higher, because if we're going to push rates lower, that's going to put a lower return on investment for the US dollar. That just puts us into more assets. Assets are likely to continue higher. Speaking of assets, here's the one that everybody missed, all right, unless you were in it, and that's SLV. You know, everyone's talking about how gold is up 30, 40% this year. The markets are double-digit higher. But look at SLV. This is the real mover, up 49% year to date off those lows in the high 20s. This is just going back into the end of April. We saw 29 on the lows. We're hitting new highs again today. Are we at all-time highs yet? Well, you got to go back to the 1980s if you want to see all-time highs in silver. The price of silver itself was trading over $50 an ounce. I saw silver trading in the low 40s today, and SLV is very close. So it runs very close with the actual hard asset price, as it too is trading at $39.73 here today. So, hey, I'm Tom Gentile, America's pattern trader. And while other traders are bracing for the worst months in decades, I already know what stock I'm trading this month. My money counter has identified the most reliable stock patterns over the next 30 days with a 90% or better historical probability. Scan my QR code or click the link below to learn how to get this month's money counter for just $9. Taking a look at these assets, we're seeing, again, trends where the markets are moving higher, trends where assets like gold and silver are moving higher. But what about stocks? So, stock market, taking a quick look at it this morning, When you look at the 52-week high low on the S&P 500 stocks, there are 17 that clocked in this morning with new 52-week highs. 107 of the S&P 500 stocks are in the top 10% of their one-year range. That means they're 10% or closer to their 52-week highs. Looking at the opposite side, we see 18 stocks that came in this morning at 52-week lows. 63 stocks are in the bottom 10% of their 52-week range. Let's take a look at the top and bottom 10 as I see them. Top 10, we're seeing Uber Technologies at the top. You got Raymond James Financial, Warner Brothers, Newmont Mining. That doesn't surprise me at all. Lam Research is in here. So is AbbVie. Now, AbbVie is a very interesting one in the mix because AbbVie is in the medical marijuana manufacturing and growing. And so that's in at number 6. Western Digital, Invesco, American Express, and News Corporation. So the real outliers on here, we see finance on here. We see metals. We see technology. And I consider Uber, some people look at Uber as a taxi service. It is much more than that. But the outliers really are AbbVie and News Corp. When you look at these top 10, what do these all have in common? They are all hitting 52-week highs and possibly all-time highs, depending on the stock, right? Looking at their high price, their low price for the last year, and where they are right now or coming into this morning. On the opposite side, you've got Keurig Dr. Pepper, fragrances, Kenvue, UPS, Target, Frank, Hormel Foods, Paychex, Fidelity International, and Kellogg. Interesting, there's retail on here, and there's foods, right? Foods like when you look at Dr. Pepper, you look at Hormel, you look at Kellogg, foods. You see Target on here. Target's definitely got some things they need to be doing very, very soon because when you look at them versus Walmart, complete disparities between price. But all these stocks, all hitting 52-week lows. If you take a look at their high prices over the year, their low prices over the year, and where they are right now, these are all meeting the 52-week low price. So adding it all up for an overall market summary, stocks, gold, and silver continue to touch new highs post Fed cut. Bonds are drifting lower, but I do see bonds really channeling themselves into a situation where we see higher lows, higher highs, or at the very worst, same lows and same highs. Volatility is creeping up as we head into October. This is normal. It doesn't suggest a pullback from what I can see. And if you take a look at trends and factor in seasonality, these are all confirmations of possibly higher markets to the year's end.